This is the Murphree Investment Group podcast. In this episode, we examine the rise and collapse of long-term capital management, the hedge fund that brought together Wall Street's brightest minds and unprecedented leverage, only to nearly destabilize the global financial system. On September 23, 1998, 14 of the most powerful financial institutions on Earth sat inside the Federal Reserve Bank of New York. Goldman Sachs, Merrill Lynch, J.P. Morgan, Morgan Stanley, Deutsche Bank, Barclays. They competed against each other every day in every market. They were rivals, not allies. They had been summoned by the New York Federal Reserve to rescue a single hedge fund, a fund run by, among others, two winners of the Nobel Prize in economics. A fund that 4 years earlier had been the most celebrated investment vehicle on Wall Street. A fund that was now, quietly and catastrophically, in the process of destroying itself. That fund was long-term capital management. What happened to LTCM is one of the most instructive financial stories ever told. Not just because of the money that was lost, though the losses were staggering, but because of what it teaches about risk, leverage, mathematical certainty, and how the plumbing of the financial system can become a trap when you depend on it too heavily. Today, we are going to walk through the complete story, from LTCM's origins through the mechanics that made up its extraordinary years of success, and into the storm that destroyed it. To understand long-term capital management, you have to understand where it came from, the arbitrage group at Salomon Brothers. Salomon Brothers in the 1970s and 1980s built its franchise on the bond markets, an asset class most of Wall Street treated as secondary to equities. As interest rates became volatile and the bond market expanded through federal deficits and the derivatives revolution, Salomon found itself at the center of the fastest-growing market in the world. At the center of that operation was John Meriwether. Meriwether grew up in Chicago, studied mathematics at Northwestern, and earned an MBA from the University of Chicago, then arguably the world's leading institution for financial economics. He joined Salomon in 1974 and became the architect of fixed income arbitrage. The core concept of this is straightforward. Similar securities should trade at similar prices. When they don't, when a price gap appears between two bonds that by rights should be nearly identical, you buy the cheap one, short the expensive one, and wait for the gap to close. By the mid-1980s, Meriwether's arbitrage group of only a few dozen people was reportedly generating a substantial portion of Salomon Brothers' trading profits, driven by only a few dozen people inside a firm of thousands. In 1991, the operation was disrupted. One of Salomon's traders, Paul Moser, was discovered submitting fraudulent bids in U.S. Treasury auctions to corner supply in specific issues. Meriwether, as Moser's supervisor, had been informed of the infractions before they were disclosed to regulators. And while he acted to report them, he did not do so quickly enough. Under regulatory standards, that delay made him complicit in the cover-up. In August 1991, John Meriwether resigned from Salomon Brothers. Most people in his position would have accepted a senior role elsewhere and rebuilt quietly. Meriwether had other ideas. He spent 2 years designing a new fund, one that would recreate the arbitrage group on his own terms, without constraints of a large investment bank. The recruitment that followed for what would become long-term capital management was remarkable. Meriwether brought over the core of his Salomon team: Eric Rosenfeld, Larry Hillebrand, Victor Hagani, and others. He added David Mullins, former vice chairman of the Federal Reserve Board of Governors, a figure who brought not just intellectual credibility, but direct relationships at the highest levels of the regulatory and financial establishment. Then came the names that defined LTCM's public identity. Myron Scholes, who along with Fisher Black published the Black-Scholes model in 1973, the mathematical formula for pricing options that created the modern derivatives market, and Robert C. Merton, who extended their work with more rigorous proofs and developed the broader theoretical architecture of contingent claims. In 1997, while LTCM was operating, both Scholes and Merton were awarded the Nobel Memorial Prize in Economic Sciences. LTCM's partnership roster included 2 Nobel laureates, a former Federal Reserve vice chairman, and the most accomplished fixed income traders of their generation. When Meriwether went to raise capital, sophisticated institutional investors did not ask hard questions. The minimum investment was $10 million, with a 3-year lockup. Every investor agreed to the terms. Long-term capital management began trading in February 1994 with just over $1 billion in assets. LTCM's strategy was based around a deep belief in mathematical models that used past results to predict future returns. The mechanics of the structure that made this strategy possible are the same mechanics that made its destruction inevitable. It's centered around an understanding of the U.S. Treasury market. The U.S. Treasury regularly auctions new debt securities in the form of bonds. When a new 30-year bond is issued, it becomes the benchmark for that maturity, known as the on-the-run Treasury. Every major trader, central bank, and futures market gravitates toward it because it is the most liquid 30-year bond. 6 months later, the Treasury issues a new 30-year bond. The new issue becomes on the run. The previous benchmark, now technically a 29.5-year bond, steps back in status. It becomes off the run. Here is what matters. Both bonds pay nearly identical cash flows, have the same credit quality, both are U.S. Treasuries, and have almost the same maturity. By any fundamental measure, they should trade at essentially the same price. But they don't. The on-the-run bond trades at a premium with a yield of 5 to 15 basis points lower than the off-the-run bond. 1 basis point is 1/100th of 1%. That sounds trivially small, but on a 30-year Treasury, a 10 basis point yield spread translates to roughly 1% of par. $1 million in price on a 100 million position. This premium exists purely because of liquidity. On-the-run bonds are easier to trade, easier to unwind in a hurry. Investors pay for that, and the premium is temporary. When the next auction occurs, the current on-the-run becomes off-the-run, and the 2 bonds compete for the same buyers. LTCM's bet was simple. That premium would evaporate. Not might evaporate, will evaporate. When the next bond gets issued, the old, new bond becomes just another bond. And the 2 prices drift towards the same price. The spread between 2 collapses towards zero in what is called convergence. The trade wasn't about predicting the market. It was about waiting for an outcome that math said was unavoidable. The trades themselves generated tiny returns, 5 to 15 basis points per position. The catch, as always, was in the execution. Turning 5 to 15 basis points into meaningful profit required enormous scale, and scale required leverage. You can get this leverage in the form of a repurchase agreement or a repo. This is one of the simplest financial instruments imaginable. You sell me a security today in order to raise capital. You agree to buy it back tomorrow at a slightly higher price. The price difference is in the interest you pay me for the use of my cash overnight. That's it. Here's how LTCM used it. The fund identifies an off-the-run 30-year treasury trading 12 basis points cheap to on the run. It wants 100 million position. LTCM buys 100 million of the off-the-run treasury. LTCM then enters into a repo agreement. It sells that treasury to a money market fund for 98 million today, with an agreement to buy it back tomorrow at 98 million plus 1 day's interest. The money market fund wires 98 million. The treasury bond is held by a custodian in a segregated account. LTCM's net cash outlay is now 2 million. That is the haircut. The margin of safety for the lender, representing the difference between the bond's market value and the loan amount. In normal conditions, haircuts on treasury repos were 1 to 2%. The next morning, LTCM rolls the repo, enters a new overnight agreement with the same or different counterparty, borrowing again against the same bond. It does this every day. LTCM earns the bond's yield, say 5% annually, and pays the repo rate, say 4.9%. The 10 basis point carry generates $100,000 per year on a $100 million position. Not very exciting, but now scale it up. LTCM had roughly $5 billion in investor equity in early 1998. At a 2% haircut, $1 of equity supports $50 of bonds. $5 billion in equity supports a $250 billion portfolio. At a more conservative 25-to-1 ratio, it supports $125 billion. 10 basis points of carry on $125 billion is $125 million per year, just in carry income before any convergence gains are realized. When convergence does happen, when the 12 basis point spread collapses towards zero, LTCM captures the price gain on the leveraged position. That gain on 30-year bonds is roughly 1.5% of par. On $100 billion of positions, $1.5 billion. From trades with no meaningful interest rate risk, no credit risk, and a historically high probability outcome. The danger was hidden in one word: overnight. LTCM was financing a $125 billion portfolio on a day-to-day basis. Every morning, repos had to be rolled. Every morning, counterparties had to agree to lend again. In normal conditions, this was nearly automatic. In a crisis, it would become the mechanism of destruction. A convergence trade has two legs. The first is the long position in the cheap off-the-run bond financed through repo. The second is a short position in the expensive on-the-run bond executed through a reverse repurchase agreement or reverse repo. To short a bond, you borrow it, sell it in the market, and later buy it back to return to the lender. If the price falls in the interim, you profit. In a reverse repo, LTCM approaches an institution owning the on-the-run treasury and says, "I'll buy this bond from you today and sell it back to you tomorrow at a slightly lower price." LTCM provides cash, receives the bond as collateral, and earns the reverse repo rate on its cash. Once LTCM has the bond, it immediately sells it to the open market. It is now short. In LTCM's case, the short wasn't a directional bet on interest rates. Both bonds would move together with rates. LTCM cared only about the spread between the two. The complete trade, long $100 million of the cheap off-the-run bond, financed through repo at a 2% haircut, short $100 million of the expensive on-the-run bond, borrowed via reverse repo. Because both positions are nearly identical 30-year treasuries, interest rate risk largely cancels. The fund is exposed almost exclusively to spread risk, the possibility that the gap widens before its convergence. This is a market-neutral position, in theory, under normal market conditions. LTCM opened in February 1994, and its timing was immediately tested. That year, the Federal Reserve began raising interest rates sharply, blindsiding the fixed income markets. Bond prices fell across the board. Most fixed income investors had a terrible year. LTCM returned just over 20%. This was not luck. It was the result of their market-neutral positioning, long cheap bonds, short expensive ones, structured to be insulated from the direction of rates. The rising rate environment was largely irrelevant. What LTCM cared about was the spread between their long and short bonds, and those continued to offer opportunities. The results that followed were extraordinary: 43% in 1995, 41% in 1996, 17% in 1997. Lower than prior years, but achieved with a far lower correlation to equity markets and a strategy that, in theory, had nothing to do with whether stocks went up or down. By the end of 1997, LTCM had achieved a cumulative rate of return of 185% for its original investors. At the end of 1997, LTCM made a decision that would later be analyzed as both disciplined and catastrophic, depending on which aspect you focused on. The fund returned approximately $2.7 billion to investors through a mandatory payout. On its face, this looked like discipline. The partners had observed that their strategies were becoming crowded. Competitors had begun replicating their trades. Spreads were narrower. Rather than dilute returns, they returned the capital. But here is what makes this almost inconceivable in retrospect. LTCM returned the capital, but did not reduce the size of its portfolio. All existing positions remained. The $125 billion plus in assets remained. All the repo financing remained. The only change was the equity base supporting it. $2.7 billion of equity walked out the door. The portfolio stayed. At the start of 1998, LTCM was running a roughly $125 billion portfolio on approximately $4.7 billion of equity, a leverage ratio of roughly 26-1 before accounting for derivatives. When off-balance sheet exposures were included, the affected leverage was far higher. The fund had voluntarily increased its fragility at precisely the moment it needed resilience, and a storm was forming on the horizon. After the Soviet Union dissolved in 1991, Russia embarked on one of the most traumatic economic transitions in modern history. To finance persistent deficits, the Russian government issued short-term debt securities, GKOs, that at their peak offered yields of several 100% annually. International investors, drawn by those extraordinary yields and by International Monetary Fund backing, poured in. Long-term capital management had position in Russian GKOs. The strategy involved buying the bonds, financing them in the repo market, and hedging the currency exposure by selling rubles forward, so that if Russia defaulted and the ruble collapsed, the currency hedge would offset the bond loss. On August 17, 1998, the Russian government made 3 simultaneous announcements: a ruble devaluation, a moratorium on $13.5 billion of domestic government debt, and a 90-day moratorium on the foreign obligations of Russian commercial banks. The domestic debt default was the element that most shocked sophisticated investors. A government can default on bonds denominated in foreign currency when reserves run out, but defaulting on bonds denominated in its own currency, bonds it could in theory print money to repay, was treated by most financial models as near impossibility. Russia proved that assumption catastrophically wrong. For LTCM, the immediate losses on its Russian positions were painful, but in isolation, survivable. Then the hedge failed. Russia didn't just default, it also suspended foreign exchange trading. The ruble forward market, where LTCM's hedge needed to be settled, simply ceased to function. LTCM lost on both legs simultaneously. Russia's default did something to global financial markets that LTCM's models had not adequately anticipated. It triggered a simultaneous behavioral response across every asset class at once. Italian BTPs fell relative to German Bunds. Danish mortgages fell relative to European benchmarks. Corporate bonds fell relative to treasuries. Equity volatility spiked. Emerging market bonds fell. The spread between off-the-run and on-the-run treasuries widened dramatically, breaking the foundational convergence trade that LTCM's model had predicted would remain stable. Positions the model said were uncorrelated turned out to be perfectly correlated in the face of genuine panic. Everything moved against LTCM, at the same time, in the same direction. In August 1998 alone, LTCM lost approximately $2.1 billion. The losses didn't just reduce LTCM's equity. They triggered the collapse of the financing structure. LTCM's $125 billion balance sheet was financed day to day through approximately 75 repo counterparties. Every single morning, those counterparties had to agree, independently, to lend again for one more day. As LTCM's losses became known, and in financial markets, very little stays secret for long, counterparties began to reassess. The first pressure came from haircuts. Counterparties who had been lending at 2% haircut began demanding 3%, then 4%, then 5%. Each increase required LTCM to post more of its own capital against the same borrowing, at precisely the moment its capital was shrinking from mounting losses. The fund was being squeezed from both directions simultaneously. Then counterparties began refusing to roll at any haircut. They returned the collateral and demanded their cash back. To repay the loans, LTCM had to sell bonds, the very bonds already trading at distressed prices in a panic market. Selling drove prices lower, creating additional losses, which triggered more counterparty concern, which led to more forced selling. This is what a funding spiral looks like from the inside. Not a sudden crash, a relentless, grinding ratchet, each turn tightening the vise. Compounding this was the copycat problem. Because LTCM was so well known and its counterparties had significant visibility into its positions, other institutions had put on similar trades. When LTCM needed to sell, everyone holding similar positions needed to sell too. The market knew LTCM was under pressure. Every attempt to reduce a position moves prices against the fund before the trade was complete. By mid-September 1998, LTCM's equity had fallen from $4.7 billion at the start of the year to less than $600 million. Its balance sheet still showed over $125 billion in assets. The fund was days away from total collapse. By mid-September, LTCM's partners were in crisis mode, making calls to potential investors throughout August and September. They approached Warren Buffett. They spoke with George Soros. They contacted major financial institutions. Every conversation ended the same way, with sympathy and without a commitment. The problem was not that LTCM's positions were necessarily wrong. The problem was that they had over-leveraged their positions. Investors could see that spreads had widened to extraordinary levels and that convergence would eventually occur. But now LTCM was under such severe financing pressure that no one could be sure it would survive long enough for convergence to happen. On September 18th, LTCM's principals called the Federal Reserve Bank of New York. The New York Fed sent a team led by Peter Fisher, head of the Fed's open market desk, to LTCM's Greenwich offices on September 20th. What they found was a balance sheet that was terrifying in its fragility and systemic implications. On-balance sheet assets, $125 billion, most of it financed overnight. Equity, less than $600 million. Off-balance sheet derivatives exposure, over $1 trillion notional. Interest rate swaps, currency swaps, equity options, credit derivatives across a network of 36 bilateral counterparties, none of whom had visibility into LTCM's total exposure. Each bank knew only its own bilateral position. If LTCM defaulted and was forced into liquidation, the forced sale of a $125 billion portfolio into an already distressed market would drive prices down further, triggering margin calls at other institutions holding similar positions, potentially touching off a systemic event the global financial system might not absorb. On Saturday, September 19, one day before the Fed team arrived in Greenwich, Warren Buffett, along with Goldman Sachs and AIG, offered to purchase LTCM's underlying portfolio for $250 million and inject $3.57 billion of new capital. Buffett gave Meriwether less than an hour to decide. The legal logistics of transferring a fund with 36 counterparties and trillions in notional derivatives in under 60 minutes were formidable. Noon came. The offer expired. Buffett moved on. On September 23rd, William McDonough, president of the Federal Reserve Bank of New York, convened representatives of the world's major financial institutions. He laid out the situation plainly. LTCM is failing. If it fails disorderly, the consequences will be severe for each of you. By early evening, a deal had been struck. 14 financial institutions agreed to inject a combined $3.625 billion into LTCM in exchange for a 90% ownership stake. The fund would continue operating long enough to perform an orderly liquidation, with an oversight committee supervising all major decisions. LTCM's partners, whose personal stakes had been worth hundreds of millions of dollars each just months before, were now working for their creditors. Under the consortium's oversight, LTCM's portfolio was unwound methodically over the following 12 to 14 months. By early 2000, long-term capital management was liquidated. The consortium recovered approximately its full investment. As the positions wound down and panic subsided, many of LTCM's convergence trades did exactly what the models had predicted. The spreads that had blown out in August and September of 1998 did converge, but LTCM wasn't there to collect. The fund had not survived long enough to be proven right. John Meriwether, Myron Scholes, Robert Merton, David Mullins, Larry Hillebrand, Victoria Hagani. These were not careless people. They were some of the most rigorously analytical, intellectually disciplined people in the history of finance. And they were wrong. There are multiple contributing factors that led to their downfall. LTCM's risk management systems were sophisticated beyond anything most institutional investors were capable of in the 1990s. And they failed. Not because they were poorly built, but because of what they could not possibly know. Every quantitative risk model is built on historical data. It describes the distribution of outcomes that have occurred in the past. History is not a complete sample of what can happen. It is a sample of what has happened so far. Russia defaulting on domestic currency bonds, the correlation of every spread trade in the world moving simultaneously. These were not in the historical database. According to LTCM's internal models, the August 1998 losses represented an event so statistically improbable that it should occur only once in 1,000,000,000,000 years. This is what practitioners call tail risk. The risk lives in the extremes of the probability distribution, events that are rare by definition, with few historical observations to calibrate from. Models based on historical data systematically underweight these tails. Quantitative models, such as this, are best used to inform your judgment, not replace it. LTCM owned long-duration assets, 30-year Treasury bonds, long-dated European sovereign debt, mortgage-backed securities. It financed those long-duration assets with short-duration liabilities, overnight repo agreements, the most short-term source of funding available in financial markets. This is a maturity mismatch. Banks engage in some degree of maturity mismatch, borrowing short from depositors and lending long. But banks are regulated, supervised, and supported by government insurance precisely because that mismatch creates fragility. A bank run destroys even a solvent bank because long-duration loans cannot be liquidated quickly enough. LTCM was running the largest maturity mismatch in the history of the hedge fund industry. Unlike banks, it had no lender of last resort, no deposit insurance, no regulatory backstop. It had only the goodwill of its counterparties, which evaporated the moment those counterparties saw its balance sheet deteriorating. LTCM needed patient capital that would wait for convergence trades to work, even if it took 6 months or a year. What it had financed itself with was the most impatient capital imaginable. The structure of your financing is as important as the quality of your assets. Long-duration assets financed with long-term capital can survive a crisis. Long-duration assets financed with overnight borrowing will be destroyed in one. LTCM's portfolio was diversified in every formal sense, spanning U.S. Treasuries, European sovereign bonds, Danish mortgages, emerging market debt, equity index options, merger arbitrage, and more. Historical correlations between these asset classes were low. The models showed that portfolio risk was far less than the sum of individual risks. The models were measuring normal market correlations. In a systemic crisis, correlations converge toward one. Everything falls together, not because of any fundamental connection between Danish mortgage bonds and Italian government bonds, but because of shared behavioral and funding dynamics. Behaviorally, all of LTCM's positions were bets on the same thing, that spreads were too wide and dislocations were temporary. In a risk-off environment, all such bets lose simultaneously. On the funding side, all positions shared the same repo financing vulnerability. When the market tightened, every position faced simultaneous selling pressure. True diversification requires positions that are genuinely uncorrelated under stress, not just historically uncorrelated. Every year LTCM succeeded, the partners' confidence in their framework deepened. Every year, the models worked and the trades converged. It became harder to ask genuinely dangerous questions. When you have been right for 4 years running, there is a powerful psychological pressure toward certainty, toward the conviction that your model is correct, your risks understood, your framework validated. The more successful you are, the larger your positions become, the more fragile your structure becomes, often without the internal voices of doubt gaining sufficient volume. The antidote is what is called adversarial self-examination. Actively seek the arguments against your positions. Look for the scenarios that destroy you. Ask with genuine urgency, not rhetorically, what is the thing that could happen that would make everything we believe wrong? Build your portfolios not just to profit from being right, but to survive being wrong. Benjamin Graham called this margin of safety. The gap between what you paid and what it's worth is not just a financial cushion. It is the institutionalization of humility, the recognition that however rigorous your analysis, the future will produce outcomes your framework did not anticipate. LTCM was built with no margin of safety. At 25-to-1 leverage, a 4% move against the portfolio wiped out all equity. There was no cushion for being wrong. Keynes observed that the markets can remain irrational longer than you can remain solvent. LTCM's partners understood that aphorism intellectually. They did not apply it to their own financing structure. Long-term capital management is not a story about bad people. It is not a story about fraud. It is not a story about ignorance. It is a story about the limits of certainty, about what happens when intelligence becomes untethered from humility, about how the same structures that create extraordinary success, the use of leverage, mathematical precision, belief in the reliability of historical relationships, transform into instruments of destruction when the world stops behaving the way the history books said it would. The dynamics that destroyed LTCM are not ancient history. In 2008, 10 years later, the same forces contributed to the near collapse of the global financial system. Financial markets have a cycle of memory and forgetting. The fear that follows a crisis fades. The profitable strategies that caused the crisis rebuild themselves in slightly different forms over the years that follow. The institutional investor who understands the cycle is not the one who avoids leverage, complexity, and risk. It is the investor who uses these tools with clear-eyed awareness of their dangers, who maintains a margin of safety when others are convinced the models have eliminated risk, who asks in every market environment, not just what do we expect to happen, but what happens to this portfolio if something unexpected occurs. What ultimately separates brilliance from fleeting genius isn't raw intelligence, and certainly not prestigious awards like Nobel Prizes. History shows us that it is discipline that determines whether exceptional minds maintain their successes or experience dramatic collapses. Thank you for joining us on the Murphree Investment Group podcast. If this episode added value to your thinking, share it with a colleague, a friend, or anyone who cares about understanding how financial markets work. You can learn more about Murphree Investment Group and our research service, Murphree Insights, at murphreeinvestment.com.